I have a very special guest today. He is a legendary investor who is self-made. He's invested in many different types of securities over the years, extensive experience. He's appeared on many media outlets, people asking him for his advice. He's also a former professor at Columbia University. He's a renaissance man in investments, so I have so many things to say as far as the interview. I don't want to take up time for the interview, so without further ado, I want to introduce to the program Jim Rogers. Jim, welcome to the think tank.
Oh, I'm delighted to be here, Sam. It's good to see you. Good to hear you.
Okay, great. First question I wanted to ask you, when I see people talk about investments, especially specifically on the media outlets, they're usually talking about stocks, bonds, S&P, Dow. But when I hear you talk about commodities. You're talking about cotton, wheat, and oil. For the investor, is this something that for the average investor to get involved in, or just look at it as a barometer to basically tell them where the underlying market is going?
Well, what you need to, all investors need to do is invest in what they know a lot about. They shouldn't listen to me or anybody else unless they know something. If you cannot spell commodities, or if you cannot spell the name of a foreign country, you shouldn't invest in things like that. Just stay with what you know. But I will say that nearly all of us know a whole lot more about commodities than we know about stocks. Even the chairman of IBM cannot know everything about IBM, but we all know what every morning before we go to work, we use sugar, we use wheat, we use corn, we use coffee, we use orange juice, we use silk if we wear ties, we wear wool, we know about cotton. I mean, we use it. Rubber if we go running, we use this stuff. We know what it is, so we know a lot more about it. I didn't say that means you should invest in it or it's a way to make money, unless you've done your homework, but at least we know something about it. And as I said, I mean, how many people can know everything there is to know about Toyota or IBM or something like that? Many people invested in .coms. They didn't have a clue what a .com was, and they lost their shirts as a result.
Yeah, so that's a very good point that you make, because, you know, any company can go out of business, but when it comes to commodities, you know, wheat's not going out of business, corn's not going out of business, right? So, in a situation like that, you're kind of investing in a very liquid asset. That's what you're trying to say.
Well, it's liquid, and it's something that's not going to go to zero, and it is simple. That does not mean it's easy, but with corn or cotton, all you got to do is figure out, is there too much cotton or too little cotton? If there's too little cotton, it's going to go up. If there's too much, it's going to go down. Now, I didn't say that was easy, but that's a lot simpler to figure out than all of the things that you have to know to really understand IBM.
It's another very good point. It's just less homework that you have to do. It's just more basic. Corn is corn, cotton is cotton. I wanted to ask you something else. You see, I've tried commodities and had little success. The problem was, it was a money management aspect. You see, I invested in it, and the problem was, even though the markets went in my forecasted direction sometimes, I was getting stopped out because of margin. That was the main problem. When I shifted to stocks, I noticed that I didn't have this issue because I wasn't trading on margin, and I had success. Is there any way to invest in the commodities markets without having to worry about margin, where you can control something in any way, like a futures contract? Is there a way to just buy it outright and hold it long term?
Well, Sam, of course. I mean, if you buy a Toyota, you can put up 100% of the money. You can buy commodities the same way. There's nothing that says you have to buy commodities on margin, on thin margin. If you want to buy wheat, put up 100% of the money. You never have to get worried about. You don't worry about being stopped out at all. And these days, there are plenty of exchange traded products where you can buy things without getting stopped out on margin. It's easy to do. Nobody forces you to buy something on 5% or 10% margin.
That's a good point. So that's another way to look at it. But basically what you're saying is do your homework. Okay, I want to shift. I know we don't have much time. I want to shift over to gold. I've been looking at gold, and my listeners have been looking at it. You know, what really bothers me, Jim, is that it's gone down so much, around 35% over the past year and a half or so. And what really bothers me is I'm looking at the underlying fundamentals. You know, if anything, they're pushing the accelerator with the QE and all the money printing. And despite that, gold has gone down so much. So if you look at the underlying fundamentals, isn't this bullish for gold? What's caused this downturn in gold, in your opinion?
Well, anything that goes down is cheaper than it was before. So, of course, you'd rather buy it cheaper than buy it high. If if they're having a sale after Christmas, people rush over to the stores and buy things because they're on sale. Well, when things go down in the market, unfortunately, people don't see it that way. They think they should sell because it's down instead of rushing in and taking advantage of the cheaper prices. Well, gold went up 12 years in a row, Sam, and that was a serious anomaly. I don't know anything that's gone up 12 years in a row without a declining year until gold did it. Now, so in my view, the strange thing is how strong gold was. Now, I would expect that gold, well, first of all, gold is now having a correction, in my view, a long overdue and necessary correction, normal correction. Unfortunately, it probably will not be, it'll be a different correction than most because it had such a strong period before. The 12 years before was so strong. So now that gold is going down, it's probably going to take longer than normal to make a bottom. I don't know if it's going to take a quarter or a year or 2 years, 3 years, who knows. But I do know gold will make a bottom, and I do know it'll be a great buy when it happens. Gold this year is having to face the headwinds of Indian politicians. India is the largest buyer of gold in the world, and Indian politicians are now blaming their problems, their balance of trade problems on gold, and are doing their best to curtail or even eliminate the import of gold into India. So it wouldn't surprise me if gold didn't take much longer to make a bottom. I don't know when the bottom will be. I hope I'm smart enough if it's down enough and I start to think that there's enough pessimism around that maybe I would buy gold again because the bull market in gold has years to go.
That's a good point. I'm also hearing that there's a difference between the market where it's being traded, such as the futures market, and the physical gold itself. They're saying that there is actually gold shortages out there. People are physically trying to get the physical metal, yet in the markets it's going down. Do you see some sort of anomaly or something going on inside here, the difference between the physical and the market itself?
I haven't experienced any shortages in the physical gold market. I know that a lot of the bulls, or certainly the disgruntled bulls, say that. But Sam, I haven't seen any shortages in the physical gold or silver market.
It's good to have that perspective.
Maybe there were for a week or two at some dealers, but if you can find widespread shortages in the gold market, please tell me. But I haven't seen them.
Okay, it's good to hear that. And I also wanted to touch on bonds quickly. It's really, there's a real anomaly here, Jim, in the bond market. And I'm talking about people generally invest in bonds. I'm talking about the bond funds. Very conventional. They've gone up like many, many years. Not spectacular returns, but it seems like pretty low risk. And you look at the bond market over the past year and a half. I mean, it's a bloodbath. I mean, even an intermediate term bond in a bond fund is down like 5%. I mean, that hasn't happened. Last time that's kind of happened like 2008. Now, if you look at the 2008 atmosphere, it was dreadful for stocks. Around that time, the S&P Dow ran down 35%. So, of course, the bond market was suffering as well because of the housing market. But this time, stocks are strong, but yet you see the bond market getting killed. I mean, this is an anomaly. I don't remember this happening. How do you explain this? I can't figure it out.
Well, Sam, many times, first of all, the bond bull market has been going on for 32 years, so we're certainly coming to an end of the bull market in bonds. I don't know if it has ended yet, but the bull market's lasted 32 years now. That's a pretty long bull market. It's going to end someday, whether it's this year, next year, I don't know, but it's going to end. Now, when the bond bull market, and back to your earlier point, bonds and stocks have frequently gone in different ways. They don't have to go the same way every month, every quarter, every year. There's nothing written down there's nothing written down anywhere that anything has to move together. That's just not the way the world works. At times things move in different ways. I can remember in days, it used to be that with the Federal Reserve raised interest rates, stocks would continue to go up. In fact, one of the great technicians of all time was a guy who said, usually what happens is the stock market, the Federal Reserve will raise interest rates 3 times before it affects the stock market. And he said you should really count on 4 times because interest rates can go up and stocks can go up. So it has happened many times in history, Sam, and many other strange things will probably happen in history too. What happens with many investors, they see something happen together for a while, and they say, that's the way the world works. But it's not the way the world works. It's just temporary things.
So this is just another anomaly and another complication as part of what you just talked about as why bonds are just moving this way? You're saying there's a lot of factors here, so this is nothing surprising, right?
Well, not to me, and as I say, many times in history, interest rates have gone up and stocks have gone up too.
Mm-hmm. Yeah, very good point.
They don't have to move together. Historically, many times when they don't have to move together.
Yeah, very good point. Quickly on ETFs, is this something investors should look at, or it's better just to hold the physical metal? Talking about gold and silver ETFs, because if you look at the prospectuses, there's really no guarantees. You know, they can go bankrupt, you could lose your money, and that's kind of scary. You know, because you're putting your money in investment. And the funny thing is, the interesting is actually, is that with gold and silver, people generally look at these investments when they're predicting, you know, unrest and uncertainty in the political atmosphere and the political spectrum. So if something like that happens, you know, these ETFs can be affected. So are ETFs safe?
Well, again, you read the prospectus very carefully. Anything, even gold in your garage, can be unsafe if somebody breaks in and steals it. So there's no such thing as safe when you're talking about the investment world. So that word does not exist in the investment world. Yeah, sure, there can be fraud. You can buy an ETF, and who knows, somebody could go into the vault and steal all the gold. I mean, it's unlikely, but it could happen. Mm-hmm. You just have to be very careful, do your homework, and be careful what you invest in. I see no reason that ETFs aren't what they say they are. Now, again, that does not preclude fraud. It does not preclude mistakes of any kind. But as I said, you can have gold in the bank, and if the bank blows up, you know, you're going to lose all your gold. I don't know any safe investment. Mm-hmm. You know any? Please tell me.
Well, I'm asking you the questions. Anyway, quickly, politically, I know you're no fan of the Federal Reserve, and people are very critical about Ben Bernanke, and some more critical about Greenspan. Now, you know something? I question this criticism because, to me, they're all the same. You know, they're working for this central bank that are together with other central banks. They're printing all this money. It doesn't flow evenly. It goes to all these, you know, central banks, and it doesn't go to the middle class and, you know, Wall Street benefits. The whole thing is that, I mean, whoever replaces him means some other face, some other name. I mean, they can make him look like a hawk. So, I mean, do you see a real difference? If somebody else comes in, he's going to be this great Federal Reserve chairman. You know, they'll take us back to the gold standard. I mean, do you see a difference between Tweedledum and Tweedledee?
Well, it depends on who the Tweedledum and the Tweedledee is. Yes, there are some people who were appointed would be extremely different. They're not going to be appointed, by the way. But all the names which are being bandied about are not much different. You're exactly right. Now, I mean, if they appointed somebody who said the Federal Reserve should be abolished, then obviously there would be a difference in Tweedledum and Tweedledee. But the twiddles that are being suggested right now have very little. The difference is not enough to even bother with.
Mm-hmm. Okay, and lastly, I read a very interesting column that they interviewed you in Forbes magazine. You talked about the shift to farming, and I was thinking about this. It's very interesting because, you know, our manufacturing capacity has been ravaged. I mean, in the 1950s, I think about 11% of our GDP was manufacturing. I mean, 24% in the 50s, and now it's 11%. So, you know, obviously you can see it. I mean, here in New York, in Brooklyn, for example, I mean, you look at the industrial areas of Bushwick and Williamsburg. I don't know if you've ever been to Brooklyn, but you know, these areas, they were making textiles. They were making all kinds of products that are now made overseas. And I mean, manufacturing capacity has been ravaged. And you're talking about farming, and of course, you know, we have the prairie lands, we grow a lot of food. So this is something to look at, but under the current political atmosphere, with the government subsidizing the big farms and the small farms are being, you know, left out. I mean, and all the regulations, we know that, you know, farmers, they can't even sell raw milk and stuff like that. Under this political atmosphere, I mean, do you see the shift to farming scenario after some certain collapse, or it's going to require some political change?
Well, the situation in agriculture, agriculture has been a terrible business for for 30 years, Sam.
Mm-hmm.
And one result of that is that right now, worldwide inventories of agricultural products are near historic lows because not a lot of people have become farmers. The average age of farmers in America is 58. In Japan, it's 66. In Canada, it's the oldest in recorded history. In Australia, it's 58. I mean, I could go on and on.
Mm-hmm.
And very few young people have become farmers. More people in America study public relations than study agriculture. So
yeah.
The world is facing a very serious problem. We're running out of farmers. We have low inventories and few farmers. So farming has to become a very exciting business, or we're not going to have any food at any price. If all the farmers are dead, where's the food going to come from? So my view is that agriculture is going to be a very exciting business in the future because prices are going to go higher. It's going to become much more profitable. If it doesn't, then they're not going to have any food, and it won't matter anyway. Or if we don't have any food, then the shortages become gigantic, and then owning a farm or being able to farm is going to be terribly, terribly important.
Yeah, I just wanted to ask you one last thing before I let you go about Ed Snowden and what's been going on with, all the outcry of what he did, and he exposed this huge surveillance that was going on with Americans, phone calls being spied on. And the way I see it, the government controlling the economy and controlling central government planning and controlling the money supply, and at the same time also spying on Americans. Do you see freedom as a package deal, as one package? Either we're free all the way, or we're under government control, economically and of course in our private lives.
That was the way the country was set up. We were supposed to be free in everything. Needless to say, that has been eroded enormously here in the past, especially the past 10 or 15 years. Washington has come down with some pretty astonishing things. They can go into your bank account, your garage, your bedroom. They can go into anything they want. They can drop a bomb on you and execute you if they want to without trial. So it's a very, very different country now than what was set up a couple of 100 years ago.
Jim, I want to thank you so much for taking the time to speak with us today, and hope we can do it again sometime.
Thank you, Sam. It was fun. Bye-bye.
Thanks a lot. Take care. Bye. And thank you to my listeners. Feel free to join the discussion about this interview by leaving comments. Make sure to subscribe to find out what's coming up next. Please like this up, and thank you for tuning in.